Warren Buffett describes The Intelligent Investor by Benjamin Graham as the best book about investing ever written. Also, it is the foundation stone on which Buffett based his investment philosophy that brought him a fortune estimated at more than $70 billion. So I thought a review of this book should be worthwhile. In the first chapter, Benjamin Graham describes the difference between investment and speculation. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Speculation is any operation that doesn't meet these requirements. So whenever you invest, don't base your decision on emotion, don't take any high risk that involves a good chance of losing your invested money, and always seek for a good return. Now you might think, but what about speculating? Is it bad? Actually, there is intelligent speculation as there is intelligent investing. But there are mainly three ways in which speculating may be unintelligent. First, when you speculate but you think you're investing. Second, when you speculate seriously although you lack proper knowledge or skill for it. Third, when you risk more money in speculation than you can afford to lose, so you'll end up broke and eventually die. I'm kidding, most probably you're not gonna die, but your fortune most likely will. In the second chapter, Graham advises us to calculate our profits after inflation. Now, most probably if you receive 2% dividends in a year when inflation runs at 4%, you will almost certainly feel better than you will if you take a 2% pay cut during a year when inflation is 0. That's what psychologists call the money illusion. So long as the nominal change is positive, we view it as a good thing even if the real result is negative. Make sure to avoid falling into this trap by measuring your investment success not just by what you make, but how much you keep after inflation. Further, you have to understand that price fluctuations in the stock market have only one significant meaning for you. They provide you with an opportunity to buy when prices fall sharply and to sell when they advance a great deal. At other times, you will be wiser to forget about the stock market quotations and pay attention to your dividend returns and to the operating results of your companies. In fact, that's what value investing is. Forming your own ideas of the value of stocks based on full reports from firms and then comparing it with stock market prices. By always paying much less and selling substantially higher than your estimated value, you will maximize your chances to succeed as an investor. This brings us to the next point, which is the margin of safety, for which Graham is well known. This term describes the difference between the price you pay and the indicated value of a stock. Its main purpose is to absorb unsatisfactory market developments. When you pay less than the estimated value, you have a positive margin of safety. And when you pay a higher price than the estimated value, you have a negative one. As you probably already know, the price of a stock tends to equal its value in the long term. That's why, on the one hand, if your margin of safety is large enough, you'll be fine even if in the short term the price of your holding slightly decreases. Now, on the other hand, in case there is no margin of safety or worse, you have a negative one and the price of your holdings falls in the short term, you'll have no assurance that the price will eventually recover in the long term. Imagine a bridge that has a weight limit of 2,000 pounds. Would you drive a 2,050 pounds car on it? Hell no! You're not insane, you don't want to die. Still, that's what a lot of people do when investing. They pay inflated prices for low-value stocks and thus in the long term kill their fortune. Never forget that a true investment is one that has a positive margin of safety, and the bigger it is, the better it will protect you against unfavorable market developments. As a last thought, even if you have a large margin of safety, unexpected things might happen to your holdings that will reduce their true value. The cheapest and simplest way to increase your chances of succeeding as an investor is through diversification. So don't keep all your eggs in one single basket. If you guys want to see more videos like this, let me know in the comment section below. Also hit the like button if you enjoyed watching this video. Thanks for watching and subscribe for more.